Govind Agarwal, research analyst at Prabhudas Lilladher, tracks the IT space very closely, is now joining us. Govind, good morning. First, if you could start with the commentary of both the management, more than the numbers, what you made out of the Q2 numbers. What do you make out of the commentary? Very, very different. TCS saying that Q3, Q4 will be good. At the same time, Infosys saying that the guidance implies that the numbers may not be that great.
Yeah, good morning. See, as you said, both the companies have given a slightly different commentary for second half of the current financial year. TCS has mentioned that they will have a better 2H compared to historical second half. So they are talking about some kind of an improvement or some kind of a better growth in 2H FY17. So one should look in the context of what they're saying. They're talking in terms of last year's growth rates. Last year the growth was about 0.5% in Q3 FY16 and about 2% in Q4 FY16. So the base for TCS is not very high to beat those numbers. So I think given they've seen some slowdown in Q2, they should recover that decline in Q3, Q4, and that's why they're talking about a better 2H compared to historical 2H for the company. Now we look at Infosys. They are facing some specific 2-3 challenges which are there in Q3 and Q4, which resulting in a slower or a weak outlook for 2H. Particularly, in case of Infosys, the RBS ramp down, which will happen in Q3. Plus, there is some impact of some benefit of GST revenue which came through in Q2, which will not be as high in Q3 and Q4. Plus, we have some furloughs impact in Q3, Q4. So, company is talking about a slower growth in Q3 and Q4 as compared to first half. So, they had a very good first half. Q1 was muted, but Q2 has been very good. So they are coming down a bit from a very good growth trajectory, from a good momentum, while TCS is indicating that they've seen the slowdown in Q2 and they hope to recover from the slowdown in second half. So they are slightly different, but in fee more because of 2-3 impacts which are client specific.
As far as these numbers are concerned, we'll get HCL, we'll get Tech Mahindra coming in. You expect commentary to be very, very different. Even last quarter, you saw HCL with a very positive commentary, but others were not that great. So you expect that to continue?
No, see, commentary will vary across companies, and I think HCL Tech may again be slightly better than the peer group in terms of compared to Tech Mahindra or Wipro. So the commentary will vary, and each company has a different, I would say, business mix and geographic presence. So for example, the exposure to UK is different for all the companies. So to that extent, the commentary will vary. For example, Wipro is more prone to energy vertical, so they might be slightly more softish. So those things are there. Again, Tech Mahindra is more telecom. So each company would have a different commentary based on the business mix and geographic mix.
Right. If you look at the numbers, there is no particular reason to cheer about the Q2 numbers, whether you look at, TCS, what's come out of NIIT Tech, some of the other mid-cap companies. Do you feel that numbers are soft, but that is something which the street has factored in?
Yeah, that is true because Q2 softness was already factored in, and company had mentioned about a soft Q2. So Infosys had been guiding down for a weak Q2 for some time. Even TCS gave a mid-quarter update, mentioning about some softness in banking vertical. So Q2 was expected to be soft, and our view has been that after the soft Q2, I think we'll see stocks bottoming out in this current quarter. And once the US elections is also behind us, I think you should see stocks should stabilize and start to go up from there on.
Right. As far as the overall numbers are concerned, overall remaining quarter is concerned, you think the focus would shift to commentary rather than margins, and what is the order intake in this quarter?
See, margins by and large, the large cap companies have been able to maintain in a very, I would say, a tight range, and each company has a specific margin guidance which they've been able to maintain despite impact of cross currency or a slower growth on the demand side. So obviously the demand, the focus will be more on the outlook, and again, see, we are at a period or a time when companies will not be able to provide you much, a very good outlook, because CY17 year budget outlook is not yet clear. So that clarity will emerge only by towards the end of the current quarter and by early March. So at this point of time, we are at a stage where companies will also not be able to give you much color about next year's outlook because they don't even know the numbers. But obviously, it will depend on how the US economy and the global economy picks up. So currently we are penciling about 10% growth for FY18, and that is what that's where the street will benchmark the next year's outlook from for the baseline.
Right. One cannot say that when earnings would recover, when you would see, big traction coming in. But the valuations currently with most of these large cap companies trading where they are, with the, business looking in soft, but still, they don't have heavy debt. They are not something like a big infrastructure company, which if it doesn't grow, will have some issues paying back their debt. In fact, they'll pay back more of dividends, rather, if they don't have much to invest. So the downside seems to be limited.
Yeah, I would agree with you that downside at current valuations appear limited at about 15 times or so at FY18 earnings. And this is, you should know that this is a cyclical low year for the sector. So whatever growth rates we are seeing about 8%, 9% for the current financial year, they are hitting a cyclical low for the growth, as far as growth is concerned. So we don't know for sure when the growth will recover, but a 10%, 12% growth rate is very much possible in the very near term itself. I think FY18 can be possible. So based on, I would say, longer term growth expectations, the current multiples are fairing towards the lower end of historical range. And as and when the growth will pick up, these multiples will appear very attractive. So we don't see any downside in these names from our valuation. Yeah.
Right. Just wanted to understand, once the US election is out of the way, how would you, look at the companies in terms of spending, in terms of data coming out? Would that be a much more important data?
So you are saying, is US election relevant now also? Is that a question?
No, once the US elections are done, the data that we get in terms of companies spending for their, IT, or the numbers of Q3, or probably the commentary at the end of Q3, all of that would be much more important?
Right. So once the US elections are behind us, then the outlook will depend only on the CY17 IT budgets. And as I told you, the clarity on that will emerge only by Jan, Feb, March of next year. So that's what market will wait for the outlook from these companies, and that will depend on how is the macroeconomic outlook in US and Europe looking like. So that will determine, I think, next year's growth and hence the stock performance from here on.
Right. Govind, thank you so much for taking out time for us. Hope to get your perspective once we have HCL Tech, Wipro, and some of the other large cap IT also declaring their numbers. Overall, the neutral view on the sector continues.